Investing in international markets is often presented as a matter of opportunity, but in practice, it is more accurately a matter of perspective. Many investors build portfolios that feel diversified because they hold dozens of securities, yet all of them are tied to the same economy, the same currency, and the same policy environment. This creates an invisible concentration risk. Expanding into international markets is not about chasing exotic returns or predicting which country will grow fastest next year. It is about acknowledging that no single nation has a monopoly on innovation, productivity, or economic resilience over long periods of time. At its core, international investing means allocating capital outside your home market, across different countries, regions, and currencies. The appeal is intuitive. Different economies move through cycles at different times. Demographics, resource endowments, political systems, and stages of development vary widely. When approached thoughtfully, this diversity can reduce reliance on any single growth engine and smooth long-term outcomes. But diversification across borders only works when investors understand what they are actually diversifying, because geographic labels alone do not guarantee different behavior. One of the most common mistakes is assuming that investing internationally automatically reduces risk. In reality, it changes the nature of risk. Political instability, regulatory uncertainty, currency fluctuations, and differences in accounting standards all become part of the equation. These risks are not inherently bad, but they must be consciously accepted. Investors who move into international markets without understanding these dimensions often experience discomfort, not because the investment is flawed, but because the risk feels unfamiliar. Familiar risk feels manageable. Unfamiliar risk feels threatening, even when it is statistically comparable. Currency exposure is one of the most misunderstood aspects of international investing. When you invest abroad, returns are influenced not only by asset performance, but also by exchange rates. Currency movements can enhance or erode returns independently of business fundamentals. Over short periods, this can feel frustrating or random. Over long periods, currency exposure can act as a diversifier, especially when domestic currency strength or weakness coincides with economic cycles. The key is to recognize that currency risk is not noise. It is part of the investment, and it should be sized and tolerated accordingly. Another misconception is that international investing is primarily about emerging markets. While emerging economies offer growth potential, international markets also include developed regions with deep capital markets, strong institutions, and globally competitive companies. Europe, Japan, and other developed markets often trade at different valuations and respond differently to macro conditions than the United States. Ignoring them because they feel slower or less exciting can mean overlooking opportunities for balance and value that only become obvious in hindsight. Understanding local context matters more internationally than it does at home. Corporate governance norms, shareholder rights, and capital allocation practices vary widely across regions. A business that looks attractively priced may be cheap for structural reasons rather than cyclical ones. Due diligence must extend beyond financial metrics to include legal frameworks, political incentives, and cultural factors that influence how companies operate. International investing rewards humility and preparation far more than confidence. There is also a behavioral challenge that often goes unrecognized. Investors tend to judge foreign markets through the lens of their home experience. When international assets underperform domestic ones for extended periods, patience wears thin. This is when diversification is abandoned at exactly the wrong moment. International investing only works if it is treated as a long-term allocation decision rather than a tactical trade. The benefit comes from staying invested through periods when different regions rotate in and out of favor. Access and implementation have improved dramatically over time. Index funds and ETFs now provide broad, low-cost exposure to international markets that were once difficult to reach. This accessibility is a gift, but it can also encourage complacency. Buying exposure is easy. Understanding what you own is not. Investors must still decide how much international exposure fits their goals, how it interacts with domestic holdings, and how volatility will be handled emotionally. International investing also forces a more realistic view of uncertainty. Economic leadership changes over decades, not quarters. Countries rise, stagnate, reform, and sometimes decline. No single forecast captures this complexity. By spreading capital across borders, investors admit what cannot be known and design portfolios that are less dependent on being right about one future. This is not a bet against any one country. It is a bet on adaptability. The most successful global investors I have observed do not constantly rotate between regions based on headlines. They build exposure, gradually rebalance periodically, and let time work in their favor. They accept that some allocations will disappoint for years before rewarding patience. This tolerance for unevenness is the price paid for broader opportunity and resilience. As markets become more interconnected, yet politically fragmented, the case for understanding international investing grows stronger, not weaker. The challenge is no longer access, but judgment. Knowing when global diversification truly strengthens a portfolio, and when it simply adds complexity without clarity, requires a deeper look at risk valuation and implementation choices. And that is exactly where we need to go next, by examining when investing internationally genuinely strengthens a portfolio, and when it merely adds layers of risk without real diversification, because the difference lies in intention and structure, not geography. International exposure strengthens a portfolio when it introduces economic drivers, valuation regimes, and policy environments that behave differently from the home market. Owning businesses tied to different consumer bases, labor markets, and capital cycles reduces dependence on a single narrative about growth, inflation, or interest rates. In these cases, global investing is not about betting on which country wins next, but about reducing the cost of being wrong about any one country. International investing begins to work against investors when it is pursued for the wrong reasons. Chasing short-term performance in foreign markets after headlines declare them cheap, or the next big thing, often leads to disappointment. Valuations can remain low for structural reasons, and reforms can take far longer to materialize than expected. When international allocations are treated tactically rather than strategically, patience evaporates quickly. The result is a pattern of buying after periods of strong performance and selling after long stretches of underperformance, which defeats the purpose of diversification entirely. Implementation choices matter more than most investors realize. Broad international index funds provide simplicity and reduce single-country risk, but they also embed concentration in dominant regions or sectors. Country-specific or regional funds increase precision, but raise volatility and political exposure. Currency-hedged products reduce exchange rate fluctuations, but remove one source of diversification. None of these choices are inherently right or wrong. They must be evaluated in relation to the rest of the portfolio and the investor's tolerance for complexity and tracking error. Global diversification is only effective when it is coherent. Rebalancing discipline is the quiet engine that makes international investing work. Different regions lead and lag over time. Without periodic rebalancing, portfolios drift toward recent winners, increasing concentration just when diversification is most needed. Rebalancing forces investors to do what feels uncomfortable, trim what has performed well, and add to what has disappointed. This behavior is difficult emotionally, but it is where much of the long-term benefit of global exposure is realized. Currency deserves one final honest perspective. It will add noise. There will be years when foreign investments underperform solely because of exchange rates. Accepting this in advance prevents frustration later. Over long horizons, currency exposure often balances out and can even protect purchasing power when domestic conditions deteriorate. The mistake is expecting currency to behave as a stable overlay rather than a living variable influenced by capital flows, policy decisions, and global sentiment. Perhaps the most important lesson of international investing is humility. No investor has a clear view of how geopolitics, technology, demographics, and policy will interact across countries over decades. Global diversification is an admission of that uncertainty. It is not an attempt to outsmart the world, but to respect its complexity. Investors who approach international markets with this mindset stop reacting to regional headlines and start thinking in probabilities rather than predictions. In the end, expanding investment horizons beyond domestic borders is not about being more adventurous. It is about being more resilient. International investing, when integrated thoughtfully, reduces reliance on any single economic story and increases the chance that at least some capital is positioned where conditions turn favorable next. It does not eliminate volatility or regret, but it reduces the risk of long-term disappointment caused by overconfidence in a familiar home market. If this discussion helped clarify how international investing fits into a disciplined portfolio, consider subscribing to stay with these long-form conversations about building resilience through structure rather than speculation. And leave a comment sharing which regions you find most difficult to stay patient with, because awareness of that tension is often the first step toward managing it wisely.